Hello and welcome everyone. Thank you for joining us today for Kerr Financial's webinar. I'm Kathleen and I'll be your host and facilitator for this session. So for today, we're going to be covering the following agenda. First, we'll start with the Q3 market review. Krista will outline how portfolios performed in Q3. Next, she'll walk through where we see opportunities and risks ahead. After that, Frank will take a closer look at trends across U.S. equities, AI-driven sectors, and international markets. Lastly, I'll step in to discuss some practical year-end tax planning tips to consider before December 31st. At the end, we'll open up the floor for your questions. Just a quick reminder, you'll note at the bottom of your screen that there is a Q&A icon in your toolbar. Please click on the icon to type in any of your questions that may come up throughout the presentation. We'll be accumulating them throughout, and we will answer them in our Q&A at the end. Before we get into the market review, I want to take a moment just to highlight our investment philosophy here at Kerr. As a discretionary portfolio manager, we act as a fiduciary, which means we're required to act in the best interest of our clients. And our approach is to build our portfolios on a few core principles, which is focusing on long-term objectives, deep diversification across asset classes, regions, and managers. And we use a multi-manager model where we carefully select and oversee best-in-class investment managers with different sales styles and specialties. That structure helps us build resilient portfolios, and it allows us to adapt quickly when the environment changes. Krista will be our first speaker today. She's the CEO of Kerr Financial, and she's responsible for overall management and leadership of our firm. She is highly accredited with multiple designations, including a CFA. She is on our firm's investment committee and leads our multifamily office division. Our MFO division provides integrated services to support our high net worth families and multi-generational wealth stewardship. Krista is a thought leader in the Canadian personal finance industry. She's appeared frequently on TV and radio and in newspapers addressing various planning and investment topics. Next up is Frank, and he's responsible for our Montreal Investment Management Group, and he's on our senior management leadership team here at Kerr. He also leads the investment committee. He started his career at a Montreal-based investment management firm, and he spent 15 years as an equity analyst, helping portfolio managers in security selection as a vice president of Canadian equities. Frank is also a CFA, and he's a graduate of the John Molson School of Business. I'm going to invite Krista to turn on our video and mic, and we'll start with the first polling question.
Thank you very much, Kathleen. Hello, everybody. As we've done in prior quarters, and as Kathleen just mentioned, we're going to run through a couple of things in my comments. We're going to talk a little bit about the third quarter, what it looked like, how markets responded, and where returns came from. We're then going to talk about the economy, and it was an interesting reminder today. One of our colleagues made the comment that markets and the economy are not the same thing, and you can really see that right now. So we'll talk a little bit about what's happening in the economy. And then we're going to talk about what we see for the outlook of where things are going, and how we would position, or how we are positioning portfolios in this environment. Before we get into those comments, though, as we've done in the past, we want to ask you a polling question. This is really just to get some feedback from the participants, see what you're thinking. So as you look towards the end of the year, the final few months of 2025, what do you, and we've experienced very strong returns, as you're going to see year to date, but what do you see as the biggest risk to markets in the balance of this year? Do you think it's the concerns around geopolitical tensions and trade friction that still exist? Is it the concern that inflation may make a comeback? Is it the concern around slowing economic growth? Or is it the overvaluation or high valuation we're seeing in the markets and narrow market leadership? Or is there something else on your mind? Sometimes people think about, slowing labor market, for instance, or the consumer strength, and will that hold up? Or potentially credit worthiness of companies and whether there are credit risks and concerns out there. So if you can take a moment and just respond to what you see as the biggest risks, it'll be interesting just to share that as we embark on our comments. Interesting. So I'm going to read these out because when people see a playback, they don't always see the responses. So we have 56% of you saying that the concerns remain geopolitical tensions and trade friction. And that's probably resurfaced again as we're seeing the concerns around new tariffs on softwood lumber that it's affecting Canadian companies, particularly, as well as the concerns between China and the US. I saw this morning that Scott Bessent is trying to say that the US may pause on some of the latest tariffs, but that friction is still there and can continue to be reignited. The next one, 28% of you said the overvaluation or narrow market leadership is a concern, that there could be some pullback in those prices of certain sectors in the economy. That might be a manageable risk. If we can take a diversification approach to your portfolio, maybe limiting that risk is possible. The third choice was 12% saying slowing economic growth, and only 4% of people saying inflation making a comeback could be a concern. Now that if it was to happen, if tariffs and other things drive inflation higher, that might impact the central bank's ability to reduce rates, which could impact growth, et cetera. So these things are all very linked. But that's very interesting. Thank you for that. And just before we move to the next slide, I don't know if people saw an article this morning. Deloitte had done a survey of Canadian consumers, which I thought was kind of interesting. In some senses, they came out with seeing some signs of resilience, but then they did talk about people's risks. So it's a bit timely to this survey as well. So one thing that they said is that people are projecting their holiday spending for 2025 to be 3% higher than last year. So that's a positive sign that the consumer is remaining fairly resilient. However, 78% of people said they'll be looking for deals. So they're going to really look for value. Even though they're going to spend a bit more, they want to do it on products where they can see a lot of value. And about 3% of households overall said that their household finances seemed 3% stronger than 2024. So those are really positive signs of resilience for the consumer, which is important in terms of driving strength in the economy and the market. But then when you look below that in terms of risks, they said 46% thought the economy would worsen over the next 12 months. 70% were concerned about recession, so an extension of the concern around slowing economic growth. 80% were concerned around tariffs, so similar to you saying that's one of the biggest risks, and 70% thought inflation could in fact resurface. So in spite of being resilient, there's some concerns out there, and that's going to be a theme you see through the comments today. So if we go to the next slide, we're going to see, beyond this one, you're going to see little highlights of what happened in the third quarter. So as people will have known or seen from their portfolios, the third quarter was again a positive portfolio return quarter. So we saw risk assets, equities rallying again, and that was primarily based on continued strong earnings from companies, as well as expectations that central banks would cut rates. And in fact, seeing the US Federal Reserve cut rates by 25 basis points, Canada the same. So those things fueled the increase in prices in the third quarter. And it was really a shift from the second quarter. The second quarter, people were mainly focused on President Trump and the tariffs. So we had that Liberation Day high tariff announcement in early April, and then the feeling that those tariffs were being sort of more managed amongst the countries. But that was the big focus last year. This third quarter, a lot more of a focus shifted to where interest rates were heading. So a little bit more of a return to fundamentals. when we said that the market and the economy are moving somewhat in different, or are two different things and can move in different directions, I think one of the things we note is that equity markets grew in value in spite of some fragility that we're seeing in the economy. So the economy is showing some signs of strain, but the equity markets continue to grow. Some of that fragility we're seeing is also signs of the labor market slowing down a little bit. We'll talk about that in a bit. But really, the growth in equity markets, again, as we mentioned above, is fueled by strong earnings growth and also rising dividends, which are probably more about companies making smart cash flow choices as opposed to the economy growing drastically. But we did see some rising dividends and strong earnings, and those helped to fuel the equity market returns in spite of some softening in some of the economic data. AI-driven investment, so companies spending on AI, including data centers and those related types of industries, has really continued to lift in U.S. investment. I think I meant lift instead of life. And rate cuts have really helped to support not only that rise in equities, but also some decent fixed income returns. So generally a positive quarter with some of those provisos that it's on top of a bit of a more fragile economy. This I thought was interesting, that Morningstar was looking at the valuation of U.S. equities. And this isn't a surprise to people, but I thought it was an interesting graphic. So at the end of 2024, we saw the map on the left-hand side of the screen, which showed that value stocks were sort of fairly valued, and some of the small caps were fairly valued, the blue being more undervalued. And there was a real concern that the growth stocks, particularly large cap growth stocks, and mid-cap growth stocks, were in the overvalued red zone, or orange zone, I guess is the color they were using. When the tariff issue arose in early April and the US market really had a sharp decline, everything moved to being undervalued. So everything was blue in April. And then since then, we've seen a real rise back in US equity markets to now looking fairly similar to where it was at the beginning of the year, with again seeing some opportunities in undervalued places in the small and mid-cap sectors, more on the value side, but really some overvalued positions in the large and mid-cap growth stocks. So not surprising, but interesting to see that it really has happened. And at the end of 2024, a lot of our questions, we were saying we felt there was some good economic data at the time, but we had some concerns about valuations. Now we're sort of back in that position where we have to think about the stretched valuations that make the market a little bit more fragile. And now we also have some fragility in the economy. So we'll reflect on those comments as we go through the slides. So this is just a summary, as we've usually shown, of various asset classes and their returns. So the bar that's on the far left, which is purple, if you can see the colors, is the return in the quarter. Then you see the year to date beside that, and the 1 year, 3 year, 5 year numbers, and it's by asset class. So on the far left, you can see we've got cash. And cash returns have been coming down because interest rates have been coming down. So in the quarter, cash in Canada was returning about 0.7% for the quarter, which is on track to about 2.8% for a year. So that's coming down from what it was over the last 12 months because of rate cuts, but still positive. The bond market is the next one, and you can see the Canadian Universe Bond Index was up 1.5% in the quarter, so not nearly as high as the equity returns, but still a positive return. And that would have been like a 6% return for the year if you had it annualized over 4 quarters. So decent Canadian bond returns. The Canadian equity market, very strong, up 12.5% in the quarter, 24% almost year to date, and 28% over the past year. So very strong Canadian equity returns. A lot of that reflecting the increase in the price of gold and the sort of gold and materials and mining sectors that we have in Canada. So that's been the biggest driver. If you didn't have all of the metals, you didn't quite see those returns, but you can see very positive returns in Canada. US equity, again, a good quarter, up 10.3%. This is in Canadian dollar terms. And you can see that that's almost the same as the year-to-date number. So, we had that positive first quarter, or positive first quarter, difficult second quarter, and then sort of coming back to where we were again. So 10.3% for the quarter, and then 11.1% year-to-date in Canadian dollar terms, 21% for the 12 months ending September 30th. International equity continued to be positive, up almost 7% for the quarter in Canadian dollar terms. And again, very strong year to date, up 21.6%. A little bit of a different makeup, though. The US equity market really was driven, as we'll see again in the next slide in a second, about driven by large IT and communication services companies. International market year-to-date returns have been driven a little bit more by value stocks and those more defensive stocks that have been around for a long time in the international markets. Emerging markets up 13.1% for the quarter. So again, very strong quarter returns, and 24% year-to-date. So some higher risk in the emerging markets, but some good returns. All of that comes together in our balanced benchmark, the combination of asset classes that we have, to show about a 6.7% return on a balanced portfolio in the quarter, 12.4% year to date, and 15% for the 1 year. So very strong returns year to date, in spite of all the volatility we saw earlier and the issues around geopolitics as well as trade tensions. So the portfolio returns have been good. The question then will become, which we'll talk about, where do we go from here? So this really just focuses again on the US equity market and the sector returns. And the lighter shaded bar, which is to the left, is for the quarter. You can see the quarter returns, similar to some of the quarters we've seen lately, were strongest in technology and communication services. Some consumer discretionary strength as well. And then also utilities, which has been, linked a little bit to the AI trade, where you see some of that tying into data centers, et cetera. And you can see, strong returns in the darker bar, which is year to date, certainly from technology communication services, but also from industrials and utilities on the year to date side. So back to a little bit of those growth sectors in Q3. This looks at the factor returns again and looking at them for the world index. And you can see that there really has been contribution from various places. So from the world side, we have seen some contribution on the small cap side, up 8.6% for the quarter. We've continued to see growth, up 8.6% and 18% for the year to date. But it's also interesting to look at value. So value wasn't where all the returns came from, but they did come to some degree internationally from value. And year to date, you're seeing a real similar contribution from both growth and value. So that's where I think Kathleen mentioned we try to look at multi-managers and pairing managers together in the portfolio. It's nice to try and have both growth and value managers within the portfolio. Certainly nice to see that growth on the US side and some international value side to contribute to diversified returns. So that gives us a little bit of a sense of what happened in portfolios in the quarter. If you want to go to the next, where I said that the markets have been strong. So markets have been really strong, but at the same time, we are seeing some strains on the global economy. So I think, in terms of strength, again, we had world trade was moving in the quarter, and AI-driven investment was lifting capital spending in the US. However, we are seeing some signs of strain. So labor markets are starting to soften. You saw that, starting with the August payroll numbers. We've got some delay in numbers coming from the US because of the halt in the government, but we are seeing some strain on labor, both in the US and certainly in Canada in terms of unemployment rate. We'll talk about that in a second. The other thing we saw in the quarter is that services inflation remained stubborn. So there's still some pressure upwards on inflation. And those two things happening at the same time puts a lot of strain on the central banks deciding what they're going to do with interest rates, which we'll talk about in a minute, because they're really trying to make sure we have full employment and to keep prices at a decent level. And so these strains in the economy are both coming at the central banks at the same time, and they have to really balance them. Global growth is showing some signs of slowing. We're seeing some below trend growth a little bit differently. Certainly in Canada, we're seeing that, but we're seeing that even in the US. And geopolitical uncertainty is still there. I know we've seen some positive agreements out of the Middle East lately, and hopefully that will hold. But those tensions still exist around the world that we have to pay attention to. And trade tensions can reignite at any point, as we're seeing with China and the US now and softwood lumber, et cetera. So those could impact inflation concerns again. So there's quite a bit of fragility within the economy that makes it important for us to pay attention to all of that, even as we're aware that we've had some positive returns. So looking at the labor market, I think it's important to focus on that. That's one of the things to keep an eye on, because if labor markets become really weak, that could impact the consumer's ability to spend, which could slow growth faster. And that's something we need to watch out for. So there have been a number of signs of weakness across the economy. Job creation has been lower than in the prior quarter. You can see, sometimes there's virtually no job creation, depending on which numbers you're looking at. The unemployment rate has risen, so to about 4.3% in the US and 7.1% in Canada. So we're seeing that happen. We're also seeing, if you look at the number of job openings and the ratio of people that are unemployed to job vacancies, both of those things are moving in the wrong direction. The number of long-term unemployed, so people who've been looking for jobs for more than 27 weeks, has increased. And people, even if they are employed, are reporting working fewer number of hours. And we're seeing more unemployment among youth as well. So all of that is a bit concerning. At the bottom of this slide, we made the comment that some economists are saying AI-driven productivity growth can soften the impact of some of this weakness in the job market. So maybe some of those jobs are being replaced by AI, and that's keeping things going and being more productive and not impacting the economic growth as much, but certainly impacting people's perception of how they feel. So it's interesting to note that seeing those softer labor numbers could signal more of a concern about GDP growth and potential for recession. The big banks in the US, the sort of Goldmans and JP Morgans and Morgan Stanleys, are still saying there might be a 30 to 35% chance of a recession. So this is a sign that would be worrisome in that direction. But I think to date, markets have really been interpreting this job weakness as a sign that central banks are going to really pay more attention to the need to have full employment and the need to stimulate the economy and less worry about inflation. So more sign that the central banks will reduce rates, which has actually been seen as a positive for markets. But I think this is a key thing we need to keep an eye on as we go forward. At the moment, it's not throwing off the consumer confidence numbers and sentiment based on that Deloitte survey that was done, but it's still something we need to keep an eye on as we go forward. Central banks, as we mentioned, are facing a delicate task. So, as I already mentioned, they have the dual mandate of trying to have full employment in the economy and also to keep prices at a reasonable level. So for a long time, they were raising rates to make sure we cooled off inflation numbers and kept prices in check. But now the worry has become, we're seeing the softness in labor markets. We have to balance that. So Chairman Powell in September concluded that the downside risk on the employment side is shifting that balance of risk to the point where they wanted to make sure they were stimulating the economy. And that led to a reduction of 25 basis points in the US, bringing their policy rate down to the 4 to 4.25% range. There's a fair bit of expectation, I think, in the market that we'll see another 1 or possibly 2 rate cuts this year and a little bit more next year, but that will depend a little bit on what happens with prices, and that, could depend on tariffs, et cetera. The Bank of Canada also cut its benchmark rate by 25 basis points on September 17th, and that was to a rate of 2.5%, which is a little bit below neutral, so signing that they really wanted to stimulate growth. The different banks are coming out with their expectations or predictions. The RBC projects another 25 basis point cut at the October meeting. Some of the other banks, I think Scotia is not sure. They think central bank may hold off a little bit more. But generally speaking, there is a downward trajectory for interest rates, which is seen to be positive for the economy and for markets. So the next slide, I think, just shows you the path of interest rate expectations moving lower. So earlier in the year, the top line, the blue line, was what the expectations were, over the next 12 months, that they might see rates come down into the 4% range. Then in the middle of the year, June 30th, we moved to the orange line, which saw an expectation of rates moving lower. And then by September 23rd, after the most recent rate cut, there's an expectation that in the next 12 months, rates would be even lower still, maybe down to a 3% rate. And this is important because, there is some concern about credit worthiness of companies and bankruptcies. I don't know if people listened to, I think it was Bloomberg yesterday, where Jamie Dimon from JP Morgan talked about a couple of the bankruptcies we've seen in the auto sector, smaller companies, but he talked about them saying, when you see one cockroach, there may be others that follow. So saying when there is that risk, that credit risk in companies, and you see a bankruptcy, maybe there'll be other bankruptcies. I think he was talking a little bit more about private debt funds and where there could be some concern there about companies managing their finances and their credit. So I think the idea of moving rates downwards helps to reduce that risk of credit that hasn't resurfaced. Not all the banks in the US are talking about it, but it was JP Morgan that was talking about it yesterday. So we're seeing a downward trend. This is also looking at the federal committee, open market committee, and their dot plot, which is where all of them, the people on that committee, the 12 people, where they look at where interest rates are going to go. So you can see for 2025, the median, which is the blue lines, are sort of down, getting closer to 3.5%. So that would signal another cut from the 4 to 4.25 that we're at now before the end of the year. And then you can see the median sort of declining over the next few years, gradually declining as we get closer to maybe 3% in the longer term. So I think that is a positive. I think that idea of we've got to watch inflation, which could come from the services inflation being sticky, and also from trade tensions. We need to keep an eye on that, because if that resurfaces, it may change this trajectory. But generally, the idea that we see rates come down will be a positive one to help stimulate the economy and keep it growing in spite of the other softnesses that we're seeing. So where does that leave us, all of the things that we've said? So we're saying that markets have been really strong, but we know there's some fragility. So markets have been strong. We know earnings are holding up. We know that interest rates are moving in the right direction. However, we know that there's softness in the labor market. There's still some concerns around inflation, et cetera. So I think all of that, we see that the markets are really walking a bit of a tightrope. There's not a lot of margin for error because of the fact that things are fairly fully priced and overvalued in certain sectors like we saw. So there's positive momentum from the AI build out that's continuing. People keep wondering, is that a bubble? Is it going to continue? But I think that movement is still going forward. You still see NVIDIA and other people saying they need more capital for things. So that build out is still happening, and the anticipated reduction in interest rates, those two positive forces are sort of just offsetting those macroeconomic headwinds and those strains that we're seeing, and the potential pressure on inflation. The other thing we worry about a little bit is the idea that complacency is creeping in. And what we mean by that is you're still seeing a lot of fund flows, especially retail fund flows into the market. We're seeing lower volatility. We're seeing sentiment be very high. So everybody seems to be feeling quite confident in the markets. We still are feeling happy with the positions we're invested in, but I think you want to be careful that you're not dismissing any of the strains that exist. So the factors that are supporting resiliency is corporate earnings are still positive. The consumer is still holding up. So to the point of that Deloitte survey, which adds to some of the US data we're seeing, AI investment spending is continuing, and interest rates are moving in the right direction. So those are all supporting resiliency. However, we have some strains that we've already identified. We have stretched valuations. So we talked at the beginning about how especially those large cap growth sectors are seeing valuations that are very high. We've got narrow leadership, so it's a pretty concentrated market, particularly in the US. There are some bubbles in certain parts of the market. We think there's still movement in AI, but the prices have gotten so high in that area, you could see a pullback before things continue to go up. And then labor market softness it has to be watched, even though it doesn't seem to be throwing us off yet, but it could impact the consumer. And then the geopolitical and trade frictions still exist there. So I think it's important to understand both of those. So there's some positive factors that support staying invested and continuing to have an equity weight, but there's also some factors that make us a little bit cautious, and that leads into how we're positioning portfolios going forward. So in terms of positioning, and you might say this is not so different than the past, but I think it's even more important now. We really want to emphasize quality. So good quality companies that don't have a lot of debt on their balance sheets, companies that have competitive advantages. We want to be diversified, so we don't want to be only in those sectors that are that have very stretched valuations, and that may mean being in other geographies and other sectors other than the ones that have been driving growth so far. And we want to have sufficient liquidity. So if we talk to you as a client and we know that you have some big cash needs over the next 6 months, then it's not a bad idea to take some profits and build that cash position now, which give you some resiliency and comfort as you get closer to the time you need the cash. So that you'll see as a conversation we'll be having with people again. We still believe having a modest equity overweight is reasonable. So we're not pulling out of the market. We're not going underweight equity, but we want to have balance by having exposure to regions and sectors where the valuations are not too high. So where we have a better margin of safety if there is a pullback. And then we want to have those stocks that have wider moats. So where they've got a strong competitive advantage, because if things do get more difficult, those are the companies that are going to have less risk on them. So these are the kinds of things we're talking with our managers about. And I think looking again at all of your portfolios, making sure we've got that quality diversification and liquidity that makes sense for you. And then we can ride these waves that happen in the market and the economy, taking advantage of those positive forces, but also diversifying to manage those cautious areas or those areas of fragility that we need to watch out for. So I think it's a lot of things to still keep an eye on. We're trying to do that. We're trying to make sure all of the managers are doing that. But I think if we do that and keep a diversified base, that we can still enjoy stable growth in the portfolios going forward.
Thanks, Krista. That really helps to set the stage. And now I'm going to turn things over to Frank Satina, who leads our Montreal investment team, and he's going to start with our second polling question here.
Yeah. Good morning. Good afternoon, everybody. Our second polling question is going to test the audience's knowledge of global equity markets, and it will lead us into our discussion today. The question is, what historical 3-year period in the last 3 decades has generated the best global equity returns? And our point of reference is the MSCI All Country World Index. Is it the 3-year period ending December 1999? That would be A. March 2012, B, which would be 3 years after the markets bottomed after the great financial crisis. Is it C, May 2015? So that would be following the European debt crisis that we experienced in 2011 and 2012. Or is it D, September 2025, which is obviously after the latest bottom that we experienced in markets in the fall of 2022. So I'll let you submit your responses to this question, and we'll wait for the answers. Surprisingly, that we've had a very strong market, but this is, I guess, to kind of illustrate how historical it's been over the last three years.
All right, I'm ending the poll. Here we go. There are the
Okay,
results.
so interesting. So the overwhelming amount of respondents responded D, September 2025, 52%. The second largest response was December 1999, following the internet boom at 28%, and 10% responded B, March 2012, and C, May 2015. So if we move to the next slide, you'll see the response, the actual results, to kind of illustrate that the period that had the strongest returns was that period following the European crisis. The return was 24%. But not surprising, but somewhat surprisingly was that the last 3-year period, that 23.6% return, was the third strongest 3-year period in the last 3 decades. So we've obviously had a very good period for global equities. And to put that into perspective, the MSCI ACWI Index has had a median return of 10% over the last 28 years. So we've experienced almost twice that level of return over the last 3 years. So a pretty impressive return. Now, this brings us to today's topic, where we'll highlight aspects of the global equity markets that we believe are worthy your attention. We'll start by tackling the elephant in the room, that is the U.S. equity market. Because of its sheer size and influence and its stellar returns, we'll attempt to highlight what investors should be considering in respect to their U.S. equity portfolio exposure. We'll then highlight an interesting paper that looks at the artificial intelligence theme and specifically underlines the potential longer-term opportunities of investing beyond the tech giants who are presently building the AI infrastructure, and to gain exposure to the companies who stand to benefit from the utility that AI and automation will enable. And lastly, we'll touch on international equity markets that have performed well of late, but may be positioned to continue to generate strong returns because of internal and external forces. So this slide kind of captures the returns for the various geographies over the last 3, 5, and 10-year period for both the U.S., developed, and emerging markets. In dark blue, you can see that the U.S. equity markets have consistently led markets over all 3 periods. I think what's most impressive is that 15.3% annualized return over the last decade. That's nearly twice the level of both returns from international and emerging markets. Now let's move to the next slide that examines the key drivers that have kind of allowed for these really strong returns over the last 10 years. We focused on solely the earnings growth in dark blue and the change in the price to earnings multiple in light blue. And what you know from this chart is that the U.S. has benefited from very strong tailwinds from profit growth that grew at an impressive rate of 9% annualized over the last decade. In addition, U.S. markets also benefited from multiple expansion that grew at an annual rate of 3.8% over the last 10 years. So some value-conscious investors would rightly point out that the degree of multiple expansion has been quite elevated. However, growth investors would counter that argument and suggest that higher valuations are justified as the technology giants have enviable business models with elevated margins, high returns on equity, and fairly sustainable growth opportunities. The point is that the leadership position that the U.S. equity markets have garnered has been supported by fundamental factors tied to strong profit growth that has also obviously been further fueled by an inflow of investor capital that has helped valuations increase. However, for equity investors, the rise in U.S. valuations has created some risks. And the first is that growing concentration risk that is infringing on maintaining a degree of diversification in equity portfolios. So if we look at our next slide, we've got 3 slides here that shows how there's been an evolution in U.S. equity markets over the last decade and a higher degree of concentration. The chart on the left depicts the geographic market capitalization of the MSCI All-Country Index. Although the U.S. economy makes up only 15% of global GDP, the U.S. now represents 2/3 of global equity markets. The middle chart shows the 3 largest sectors in the S&P 500, and now that they total now 60% of the index, and 1/3 of that is concentrated in technology. But perhaps the most concerning is the level of concentration at the individual stock level. So a decade ago, the top 10 stocks represented 17% of the S&P 500. Today, that's closer to 40%, and it's rising. So U.S. markets have always historically been considered almost an ideal equity model for portfolios. There was a great deal of diversity with global leaders across different sectors, and there was no one company that represented a large share of the overall market. In fact, in 2015, there were no companies that had a weight of 3% or more in the S&P 500. Today, there's 6 stocks that have a 3% weight or higher in the index, including NVIDIA at 8%, and both Apple and Microsoft are representing short of 7% of the index, respectively. The next slide highlights a second risk, which is tied to elevated valuations. So this chart from JP Morgan looks at the price to earnings multiple of the MSCI All Country Index, excluding the US, relative to the PE for the S&P 500. What you'll note is that international markets had valuations that were trading at a discount to the US in that 10 to 20% range from 2005 to 2017. However, that discount really steepened a great deal. And as of June 30th, it stood at 36%. So that's an extreme 2 standard deviations below that 8% historical average. The next slide tries to illustrate the third risk factor impacting US equities, which is more of a recent development. The drastic shift in policies relating to trade, immigration, and the oversight of key institutions has caused the US economy policy instability index to spike to all-time highs. I would say today, this has not weighed a great deal on US equity markets on a sustained basis, but we still believe that the different approach this administration has taken in dealing with its trading partners does present a risk to its corporations in the long term. Now, given these risks, how should investors adapt to managing their exposure to US equities? The first point we want to emphasize is although we believe a more active approach would be prudent, there's no reason to avoid exposure to the US because it's simply too attractive a market to ignore. The US boasts the deepest and most liquid capital market across both public and private equity markets. It has a large and productive labor force and has the capacity to attract a steady stream of skilled workers that very few countries can replicate. The US economy is also quite resilient and less vulnerable to the cyclical impact of business cycles, as it's largely dependent on the consumers. So less impacted by international competition related to manufacturing or exports. The US is also the world's largest oil and gas producers, and through innovation has untapped enormous resources for the country. And lastly, despite the efforts of the current administration, the US still has institutions and laws in place that give global investors the confidence to invest in the country. Now, we still believe that the US should represent a core part of a global equity portfolio, but we do have 2 caveats we want to emphasize. The first is the AI theme that has, I think, the runway to have a material impact on the economy and markets. And US companies, whether they be public or private, are at the epicenter of this innovation. Therefore, investors need to invest in these companies to benefit from this investment theme. We would, however, advise that additional discretion be taken as we've highlighted the concentration and valuation risks in the space. We also think the opportunities exist outside that Magnificent Seven. So this chart exemplifies this idea. So despite the fact that the S&P is at all-time highs, nearly half of the companies index have seen a negative year-over-year price change. So there's been major price gains in the large mega cap companies, but nearly 200 stocks in that index have experienced no gains. So we see that as an opportunity to look a little deeper, reason to maintain exposure to the largest market in the world. The next item touches on the investment theme that I think has supercharged the returns over the last 3 years. With the launch of ChatGPT in late 2022, it was really a key moment for investors, and we've witnessed the unleashing of massive capital spending programs by the likes of OpenAI and Alphabet and Meta that has seen trillions of market capitalization added to the tech sector. A paper that was published this past April by Morgan Stanley looks at the prospect of investing in AI beneficiaries. So AI and automation are poised to be disruptive forces. They will reshape the investment landscape with certainty. But the authors of the papers noted that while the market often bids up the value of the enablers of the new technologies, historically, over the longer term, companies that effectively use the technologies create the most value. So, for example, at the start of the last century, the automobile changed the investment landscape. Yes, for shareholders, reaped massive benefits over that subsequent 4-year period, with a 23% fold increase in the value of Ford shares. But what the automobile did was it drastically improved mobilization and urban sprawl across the US. This allowed big box retailers to flourish. Walmart was a second order beneficiary, and shareholders reaped the benefits and experienced a 1,622-fold increase in the value of shares between 1980 and 2020. We see the same pattern with innovation of wireless fiber. Cisco was a big winner as it provided the equipment to build wireless networks worldwide. However, one of the second order beneficiaries was Netflix that used those networks to stream video. And this has led to greater value created for Netflix than it has for Cisco. I think today we see GPU and hardware manufacturers as the first order beneficiaries, but we believe that there certainly will be companies that reap the larger rewards from AI and automation. For this very reason, we emphasize the benefits of remaining diversified and owning companies outside of the Mag 7, because you're likely to increase your odds of owning the next Walmart or Netflix. Our final topic touches on the opportunities in international equities. I think the last year has been fairly promising both for developed and emerging markets, as some of the turmoil we've seen in the US has caused investors to veer their attention to foreign markets. The question is whether international markets can retain this market leadership. While demographics and other structural characteristics make equity markets in Europe, Japan, and China less appealing than the US, we see 3 reasons of optimism for international equities. The first relates to the changing political landscape in Europe. Whether it be the Russian-Ukraine conflict, or I would say the more adversarial relationship that it has with the US, European policymakers are realizing that major fiscal spending is a necessity. This chart highlights that Eurozone government spending is expected to exceed 450 billion euros in 2026. That's almost twice the level we saw in 2018. This increased spending should boost domestic economies and support prospects for companies in the industrial, in the material space, and obviously in the financial sector as well. I think the second catalyst for international markets is a heightened focus on corporations to improve governance practices and actively seek to improve returns for shareholders. Japan is a prime example where boards have been engaging with management to surface value by either entertaining asset sales, share buybacks, or other measures. This chart illustrates this trend where announced share buybacks in Japan have more than tripled since 2020. Aside from Japan, the success of the US corporate model that strives to benefit all shareholders and not only majority shareholders is influencing corporations in Latin America, Asia, and other emerging markets to unlock value by taking proactive action. The final potential catalyst for international equities is tied to currency markets. So this chart shows the relative performance of international versus US equities, and it highlights periods when the US dollar was depreciating and how international equities outperformed. So the trade-weighted US dollar peaked in September 2022 and has fallen 11% since then. And on a purchasing power measures, the US dollar still looks like it's 15 to 20% overvalued. If we do continue to see that trend in a weaker US dollar, it could present another tailwind for international stocks to do well. So in summary, equity markets have had a historically strong period of returns. There are concentration and value risks in the US that investors should prudently be looking at investing outside of the growth tech giants and also investing in companies that are more attractively valued. The AI theme will unleash interesting investment opportunities, and investors should be seeking to diversify outside of the Mag 7 and into the second order beneficiaries like Walmart and Netflix were during periods of previous innovation. And lastly, maintaining exposure to international markets has been rewarding in the short term, but there are catalysts to carry that momentum and drive benefits for equity portfolios. That summarizes my thoughts. I'll pass it back to Kathleen.
Thanks, Frank. That was great and very enlightening. I'm going to look at a few tax planning strategies just at the end that you can consider as we approach the end of the year. It's always worth taking a few minutes to step back and make sure everything in your plan, if you have one, is working together. And if you don't have a plan, it's a good time to think about putting one together. Today, we're going to look at opportunities to harvest losses to offset your capital gains that might have happened with the high markets this year to mitigate your taxes. We will briefly look at how to review a family trust to confirm if it's working for you. We'll walk through charitable giving plans and end with a reminder just to ensure your registered accounts are topped up before December 31st and working for you. So let's start with one of the more common areas we look at, and that's capital gain and loss harvesting. We look at that with our clients regularly. The way it works is if you've realized capital gains during the calendar year, you can take a look at your portfolio and see whether any investments are showing a loss that you could possibly use to offset them. Realizing the loss can reduce your 2025 tax bill, but you do need to keep a couple of rules on mind. With the T+1 settlement cycles, you will need to make your trades before December 30th to count for the 2025 year. But of course, we wouldn't recommend leaving it that late in the year to complete your trade. And under Canada's superficial loss rules, if you sell a security at a loss and buy it back the same or an identical one within 30 days and still hold it at the end of that period, the loss is denied and instead added to your cost base. So you want to make sure this rule doesn't apply if you're using this strategy. Reviewing this before the end of the year can help you lock in your gains where it makes sense, take advantage of losses if it's possible, and keep your your investment strategy tax efficient. From there, another area to revisit before the end of the year is your family trust, if you have one. So if your family uses a trust to help with expenses like private tuition or other costs, it's really a good idea to review it each year. You'll want to confirm that your trust has realized enough income to make use of lower marginal tax rates among the trust beneficiaries. If enough income hasn't been earned in the year, you may want to realize additional income, for example, by triggering a capital gain before the end of the year. So there's really a sufficient income to allocate out to the beneficiaries. A beneficiary with no other income can usually receive about $16,000 tax-free if you take into account the basic personal tax credit. The income allocated from the trust also doesn't need to be paid in cash. It can be made through a promissory note, which allows you to keep the money invested in the trust, and you can use it at a later time to pay the expenses like tuition, for example. And if the trust was funded through a prescribed rate loan, it's really important to remember to pay the interest by January 30th of the following year, so that would be 2026, to maintain that income splitting benefit. These are just quick reviews to keep your trust compliant and ensure it's working for your family's best interest. So planning ahead, another area to think about is charitable giving. So in situations where you're considering charitable gifts at the end of the year, there's an opportunity to look at how are you making those gifts most tax effective, whether you're donating cash or securities, and whether it makes sense to give them personally or in some cases through an investment company if you have one. Donating publicly traded securities with accrued gains personally can still be highly effective. The capital gain isn't taxed under the regular tax system, and you receive a charitable credit for the full fair market value of the shares, which reduces your taxes. However, something to keep in mind since 2024 is that there are new tax rules that have come into effect that can, in certain situations, limit the deduction. The rules are covered under AMT, Alternative Minimum Tax, and it's worth checking whether they apply in your situation. The rules are fairly complex, so we'd recommend speaking to your advisor at Kerr if you are donating securities, just to be sure it doesn't apply in your situation. Lastly, before the year wraps up, it's a good time and always a good time to review your registered accounts to see if there's any contribution room you can take advantage of, being mindful, of course, not to over-contribute. For your RESPs and RDSPs, making a contribution before December 31st can also help you receive the very important full government grant available for the year. With the RESP, the government matches 20% of what you contribute, so that's up to $500 per year. And if you haven't contributed in the past, you can catch up with a one-time amount for a maximum grant in the year of $1,000. And with the RDSP, the rules are more generous, and you can actually catch up on 10 years of missed grants, up to a maximum of $10,000 in a year. So if you do have any unused grant room in either of the plans, this is a great time to take the time to top them up and make sure you're getting the benefit of the government contributions. Lastly, take a look at your RRSP and FHSA contribution room to make sure you're maximizing your tax sheltered savings before year end. And if you are turning 71 this year, you'll need to evaluate whether to convert your RSP to a RIF, or if you have locked in funds to a LIF or another retirement income option. If you don't convert by December 31st, the full value of your RRSP is treated as taxable income, which can result in a significant tax bill. So the actual tax impact will depend on your situation. So again, it's important to review this with your advisor to understand how it applies to you if you're turning 71 in the year. Lastly, if you do have RSP contribution, you might want to consider making a final contribution before converting. Taking care before the end of the year will give you a chance to get your savings to grow and working for you while heading into the end of the year. And keep in mind, as we say, every situation is unique. So if you do have questions, really feel free to speak to us at Kerr or speak to your own advisor to see what makes sense in your specific situation. So I'm going to open up our Q&A and I'll turn off the sharing and I'll ask Krista and Frank to turn on their, let's see.
We are back.
Okay. Great. So welcome everybody. So I do have a couple of questions that have come up and we have a little bit of time. So let's cover this one. So Krista, I'll direct this one to you.
Sure.
So one of the things you mentioned was that the risk assets rallied on strong earnings despite what was going on in the labor market weakness. And how have our managers been interpreting this? Do you see it as a sign of resilience? Are they becoming more cautious given the valuations?
Yeah, I think it's a combination. And we have seen investment firms that we work with remain invested. So people are still looking for opportunities. But I think it gets back to that idea of wanting to really look for diversification. So, because markets have gone up, valuations have gone up, and we know there's that fragility that we talked about, some of those strains on the economy. So it's important, again, to be diversified and to make sure that you're looking for opportunity in sectors that are not too highly valued. So I don't think we've seen people completely pull back. The other thing we've seen with a few managers is they're keeping a little bit of extra cash around because they see some companies they like, but they're not quite at the prices that they want to pay for them yet. So there was one manager that we work with that's usually 100% invested and has about 9% cash on hand right now, just waiting for those prices to come back into the right level for them. So I don't think we're seeing people, completely take money off the table, but we're seeing them make sure that they're looking at diversification and then maybe keeping some cash around for the time those prices come back into good focus. I don't know, Frank, if you're seeing something different from some of the managers or.
Oh, I am seeing that cautious stance that kind of, I think, started to materialize at the beginning of the year, and it's kind of persisted. They haven't really budged from their more cautious position in terms of whether that be in equities or in fixed income. There's a more defensive structure in some of the managers' portfolios.
Yeah, so I think people are paying attention to those signs of strain in the economy and being a little bit careful, which I think is good. I mean, we don't want to chase trends, and that's where you do see a little bit of the fund flows, still rushing into certain sectors, and I think you want to be a little bit careful. So that cautious optimism is a better place to be right now, and yeah, we're seeing, as you said, like at the end of last year, there were some managers that took a little bit of money off the table, reducing their risk positions a little bit, and maybe they're starting to look at that again. But it's not a wholesale sell everything and get out. It's just be careful.
Interesting. And what about with the Fed and Bank of Canada cutting rates in September? How are you seeing our fixed income managers responding? Are they extending duration, still keeping their portfolios short, given inflation risks? What's going on there?
Frank, do you want to comment on that? Oh, we're having trouble hearing you, Frank. Actually, we're not hearing you at all at the moment. There you are.
Yeah, I think the duration is probably a little longer than it was at the start of the year. So there has been an extension on that front, but it's not material. And I would say the fixed income managers have operated from a very defensive posture. There's less exposure to corporate issues in portfolios. There's, I would say, less exposure to high yield in portfolios. I think their concerns has been that valuations also in the fixed income space are a little stretched. There's not a lot of premium being offered for taking additional credit risk. So I would say the positioning hasn't changed a great deal. It's longer duration, but not drastic, and still very defensively positioned with a lot of exposure to I would say the sovereign, provincials and federal issues.
Yeah, it makes sense.
Well, just looking at the time, I'm going to wrap it up. And if you each could think of one theme that investors, should carry into 2026, what would it be? Is it patience, diversification, or is it something else that stands out from your discussions? Krista, maybe you can start.
I mean, I think we've been still talking a lot about diversification, which we know hasn't been the most popular because you see certain sectors really being the ones that have driven growth. But I think it's important to look for those opportunities Frank highlighted. There are opportunities in sectors that haven't run up as much. And so to be a little careful and make sure you've got diversification across the portfolios to take advantage of that and not to be so exposed to the highest levels. I think that might be mine. I don't know if Frank, you want to.
Well, I would share that with you. It's very important.
Oh, we're not hearing you again. Sorry.
Yeah, I would say liquidity would be my second, my comment. I think you highlighted that in your comments. I think liquidity is important. We've seen some of our managers do that within their portfolios, and I think investors should consider that. Remain invested. There's nothing at the forefront that thinks that shows that 2026 is going to be a year with a drastic shift in market performance. But nonetheless, we think having a degree of liquidity in the current environment where a lot of assets are richly valued makes a lot of sense.
Yeah, so I think maybe it's back to those three things that we said. We talked about quality, diversification, and liquidity. And those, are good things to make sure. I mean, certainly something we're looking at when we're looking at overall portfolios and talking to our managers about. And I recommend that to people as they look at their portfolios as well.
Well, no, that's really insightful. Thank you both, Krista and Frank, and everyone who joined us today. We hope you enjoyed the session. You got some clarity and context as we head into the balance of the year. And as always, if you have any follow-up questions, please don't hesitate to reach out to one of us here. We'd be happy to help you out. And a recording will be available and will be sent out shortly, so feel free to share it or with anyone you think might find it helpful. On behalf of all of us here at Kerr Financial, thanks again, and we hope you enjoy the rest of your day.
Thank you,
Thanks,
everyone.
everybody.